Good afternoon. Today, we're going to be chatting reframing grain marketing from price reaction to risk strategy. Before we dive into today's topic on grain markets, we're going to dive a little bit into the economic side of things with a quick macro and ag economic update. I'm Megan Roberts, ag economist here at Compeer Financial. We're going to start out with a look at the macroeconomic indicators that are affecting today's interest rates. Then we're going to talk about some crop price trends in the most recent world agricultural supply and demand estimates. Welcome to Compeer's Ag Edge, brought to you by Compeer Financial. In each episode, we break down complex agricultural economics, policy dynamics, and farm business topics into conversations that make sense for your operation. We're here to help you stay informed and confident about the trends and decisions affecting your agricultural business. So first things first, what's going on with the Fed? Literally minutes ago, the Federal Reserve Open Market Committee made their March rates decision, and they were utilizing these data points to make their decision. GDP right now, we're looking at the quarter four of 2025 second estimate. That was a little bit softer than what was first anticipated. It was at 0.7%. For context, a healthy GDP rate is a little bit stronger at 2 to 3%. Why was this so low? You'll have to think back to fall of 2025 when we had a 43-day long government shutdown, and that did affect the GDP. From a job situation, we're looking at a little bit more recent data from February. The national non-farm unemployment rate was a little softer than maybe would be ideal for the Fed. They're going to be looking for a range between 4 and 4.5%, and we are getting to that top end of a healthy range at 4.4% unemployment for February. The more concerning number is that second number, negative 97,000 jobs growth nationally, is indicating some weakness on the labor market side. Lastly, we've got PCE inflation. What's going on there? That's the Personal Consumption Expenditures Index, and that is the Fed's preferred measure for inflation. And in January, that was at 2.8% for overall. And we will have to wait a few more days before we get February data. And then really what I'm going to be looking at is in the future months when we have March data, how has things like a recent spike in oil prices affected our inflation? I think that's going to be a big question that the Fed is watching, as well as economists like myself. So in light of me just referencing a pretty significant shock to oil prices, a lot of unknowns, and with the implications of developments in the Middle East, the Fed at 1 o'clock today, couple minutes ago, announced that they are making no changes to their federal funds rate. So they're going to keep the federal funds rate at 3.5 to 3.75, indicating that there was a mix of financial data. We've got a little bit softer on the labor market side, a little bit of some increased inflation, but we have to really wait and see what happens with things like oil prices as they work their way through the economy. This was widely anticipated ahead of time, and the Fed doesn't set market interest rates. The market does, and the market had sort of baked this in ahead of time. So this is really aligned with where I anticipated these rates would come for today. We'll have to see what happens again in 6 weeks when they meet for the next time. Let's move away from interest rates and talk a little bit about crop prices. This is a bit of a preamble or the appetizer to our main course, which are our guest speakers. What's happening with crop prices? Well, it depends on whether you're talking farm level crop prices or talking about futures on the board. A lot of action in the last couple of weeks, just as oil prices are affecting other commodities. But when it comes to the WASDE, the World Agricultural Supply and Demand Estimates, our last report didn't have a lot going on. So we're really in the same place we were in March. as we were in February and January. Very small changes to beans in March, but a small 5 million bushel increase in imports for soybean oil. Overall, we're staying very steady at that predicted $10.20 per bushel for old crop beans. There are initial estimates out for new crop beans. It's not in the WASDE yet, but in USDA outlook reports, and they're about a dime higher. Wanted to mention, and why I put it on this slide, even though this is old news, just as a contrast to the 2026 planting intentions report that's going to be out at the end of this month. Where did we end up with harvested acres for last year? As a reminder, it was 80.4 million acres nationwide for soybeans and at 53 bushels per acre. Moving on to corn, again, not a lot going on in the WASDE, staying at that 410 per bushel. We had the 91.3 million acres in harvested, 98.8 million for planted. Exceptional yield, still sticking at the 186.5 bushels per acre, and fantastic record-breaking exports for the harvest season. So while the crop price cost squeeze continues, government payments are filling in the difference and could, in my opinion, affect some of those planting decisions. It might be one of those subconscious decisions as we think about things like farmer bridge assistance payments, and that corn had a payment rate at $44 per acre, soybeans in the $30 per acre range. There might be some subconscious choice to keep a little bit status quo in terms of that acreage mix. If we look at things like the soybean to corn price ratio, maybe an indication to switch more to the soybean side. In the outlook from the USDA, there are many unknowns. The most recent has 85 million soybean acres. I've added the question mark, not the USDA. They didn't put the question mark behind their data. And then 94 million corn acres, again, with that question mark. We'll have to see there, in addition to government payments, I would say the current events of higher oil, fertilizer, soybean prices on the futures market, that subconscious choice of, if you have that ability to switch acres, would you switch to soybeans on more marginal ground? I think there is a lot of let's wait and see what really happens in the data. So like many economists, I will be diving deep into the planting intentions report at the end of the month. And there is a lot to go of spring 2026 before we know what will actually happen. But with that, I think one of the arguments that our guest speakers are going to make is that you need to take some of that price reaction out of the mix and think about grain marketing from a holistic risk strategy. So let me introduce our speakers today. We have Jeff Kazin, who spent 30 years with Cargill in senior trading, risk management, and leadership roles across grains, oils, aquaculture, and feed. He led export wheat trading and M&A strategy initiative. Jeff owns and operates farms in Ohio and Minnesota. He also holds a BS in agricultural economics from Ohio State and an MBA from the University of Minnesota. Our other guest speaker is Mike Rolson, who also brings 30 years of agricultural experience, including 19 years with Cargill in U.S. trading, leadership, international expansion in Ukraine, and corporate strategy. He later worked in ag tech startups and venture capital. Mike owns 2 farms in Minnesota. He holds a BA from St. Olaf College and an MBA from the University of Minnesota. A lot of University of Minnesota folks here today. Skayuma. With that, I will hand it over to Mike and Jeff.
Thanks for having us.
Yeah, great to be here today. Thank you, Compeer, for having us. We're going to preface this a little bit when we talk about grain marketing here, that we're not going to be talking too much about predictive anything when it comes to futures and that sort of discussion. We're really going to drill down, getting in the mindset of being a physical grain merchant and some of the best practices that we see in the folks that we've been around and the folks that we've taught up. We're about approaching 4 years now in this and have touched between our teaching business and our more direct integrated consulting with producers. We've touched over 300 farmers, both in the United States and Canada. We're sticking to some real core basics today and the 5 best practices that we see when really reframing your marketing strategy to think and function like a merchant and a risk manager. We're often confused a lot of times when we have these conversations. So we are educators and consultants, and we really, as I've already said, focus solely on merchandising and best practices in risk management. We brought a lot of experience to this, a lot of this on the physical trading side. So our mission in life basically is to teach growers to think and function in the same way we do and the same way your buyers do. And it really results in some very rewarding outcomes when folks roll their sleeves up and learn and actually execute upon these things. Our mission in life was brought about, and I credit Jeff on this, that a little bit too much slips away from the producer to your buyers because they are versed in these skills, and all too often producers are not taught them. So our mission in life is to level that playing field.
Just getting through the agenda, this is what we see the top 20% of our clients do. And remember, we're an education business. We're not your typical broker. We're not an advisory, right? We're working on real skills with growers, either through class or through one-on-one relationships. So we're going to look at understanding a little bit more about how efficient the futures markets are for your growers that are in commodities that have futures markets. That's cotton, wheat, corn, soy, canola here in Canada. We're going to talk about critical step in separating futures and basis marketing decisions. Very basic, but not all that we can see from even price move. That's not always the case. Knowing your position. We've been at this almost 4 years. We've yet to be on a farm that actually knows its futures risk position and what we would call a world-class detail. And that brings a lot of clarity. Understanding the true cost of carrying grain on the farm and how to merchandise around that and drive value like an elevator. And last, using the market structures to help inform when you should be moving physical grain. We're not talking about futures. We're really talking about the basis and driving value, making sure we're down in those really minute details that drive value to the farm and effectively make money just like an elevator. So those are 5 kind of critical blocks where the top 20% of our clients focus energy and excel.
So we often throw this curve out there to illustrate a point that you can actually prove in the data at any one time. The fact of the matter is, though sometimes we curse the current prices at the moment, but the fact of the matter is there are thousands of well-informed and financially backstopped decision makers that are creating a tremendous amount of price discovery and price efficiency in today's commodity markets. And we'll just use the example of the CME. And these markets have become incredibly efficient. You can literally prove that 50-50 reality of that next price movement in the market mathematically at any one time. We really look at the futures market as a 50-50 bet, and we could prove it in the numbers and other things that we do around options and stuff like that.
What Mike's really trying to tell you is the best source of information that you're going to get as a farmer actually comes from the market, because there's just huge amounts of money. In my previous life, we had hundreds of people, everything from PhD mathematicians to the best of in weather forecasting, all on my team, right? There's hundreds of my team out there, and they're putting on positions. So kind of the summary of all this effort and that comes into the marketplace is the price. If you were bullish, you'd be buying it from all your information and pushing the price higher, or vice versa. We challenge any of you who are on this call, when you get done, try this. At the end of the day, go find out, pick a month, go to the, say, July calls and corn, something very liquid, and say, at the money where futures closed, if you can find a put and a call that are exactly at that level, right, where we close, see if they price the same. And then go, 10 cents a bushel either side. And you can use cotton or crude oil or any efficient market, and see if the put and call equal distant from the close are priced the same. Because if you think a put and call is either price insurance, either one price, I'm a farmer and I want to make sure that I have a put under me so my price doesn't get any lower. I buy price insurance that way. Or let's say I'm a swine feeder and I don't want to pay any more for corn, so I buy a call. Think of it as insurance. In an efficient market, those prices will be identical. And you'll go in tonight, you can post this and go look that up. You'll see that they're very close. And what that says is the market is super efficient at the close around, basically, it's a 50-50 percentage that the market's going to go either way at that moment of close. And that plays out day after day in efficient markets. And that's why we try to make that jump that these super efficient markets, your best source of information actually comes out in the price.
So one of the points we make here, futures are an equalizer, and the reality of it, and it's a future discounting mechanism. It's always sort of looking over the horizon and placing those bets. And the reality, when price synthesizes up every day, a lot of the information that maybe you think is current is often quite old. A lot of times it's already been traded, it's already been discounted. And so anything you're hearing about today, say in a market report that may be newsworthy, there were people digesting that and putting those bets on prior. To Jeff's point, we came from a world that had some of the best traders on earth with global reach, global intel, and also teams trying to also figure out where we should be on this curve. And those folks are constantly digesting that information, are coming up with their own and putting bets into the market. That's some of the challenges that we see with advisory related things and newsletters. It's an incredibly difficult challenge to try to outguess that big unwieldy beast of a market. So what you wouldn't want, quite frankly, is the opposite. Like I said, we sometimes curse the CME and the price we're dealing with in the moment, but the last thing you would want is global trading skill set, commercial entities competing against you without that normalizer every day on CME at 1:15 Central Time. So Jeff and I can talk at great length all the times we traded things that aren't given that price transparency in Chicago every day. Things like fish meal or scrap metal or things like that traders can really take advantage of. So think of this, as Jeff already said, as a beautifully orchestrated, globally participant situation where it comes out in price every day. The world comes to price grain in Chicago, and it is a gift of transparency for the U.S. producer.
Yeah, the U.S. farmer, and me being one myself, right, we're outgunned in information, and that gets significantly worth in markets that aren't well traded. And some of you that are in things like maybe alfalfa or dry beans, right, you don't have that transparency, and so you can feel that. And by far in my trading career, we struggled towards the end of my career to make consistent money trading futures markets, but we did very well in markets that were opaque. Like Mike said, everything from, say, cottonseed oil to fish meal when you're feeding the world's salmon. So lots of examples of how that transparent, how that market is a great source of information for you as a farmer, and it's free, right? Available to see for all. So a few best practices around using futures, right? And hedging accounts, this is one that's very counterintuitive. Hedging accounts over a long period of time should not make you money. And the whole world will go, oh my God, I get a hedge account, you're going to make more money. That shouldn't happen, right? Because the moment you hedge, it should be on a 50-50 bet. And it's over time. Sometimes that'll be higher or lower. That's actually been my personal experience. What a hedge account does for you as a farm is it reduces your earnings volatility. It's not there to keep score. It's not actually even a profit or loss, right? Because you're hedging, you have grain against it. But that's a different mindset, right? Having a hedge account will not make you money. It should. If it does, you should become a trader. And so that's something that we bring as our experiences. Going with the right mindset, if you're going to hedge or you're going to use HTAs, things to control futures risk, that it's about reducing volatility, not about actually making more money over long periods of time. Know how different things in what you are doing are actually increasing or decreasing risk. We see a lot of activity out there for various reasons where producers get into products, particularly products where we're not actually hedging, or we're what we call a Texas hedging, right? When you're actually buying crop, you're getting even, naturally farms are long, they own commodities across it could be a variety. So when you add things back, are you actually adding risk? Are you going to turn into a product that actually is adding risk back? So know exactly in the detail what products you're using. And the third bullet that we see really good producers with is there's nothing wrong with speculating if it's within your individual risk profile as a farm. We ask that you separate it, right? It's very important when we switch over. We have a farm management consulting practice that you separate your speculative side of the business from managing the risk for, say, the grain side of the business if you had both. You don't want to get in a situation where you're having a poor speculating year, like is the business, the grain business, insolvent, or vice versa. We used to see this a lot actually on our side. We're having a really good run and executing around trading. It makes the core business look better than it is. And it may delay you making decisions. So between speculating and managing risk for the farm, to just have a separate account if you want to spec, we don't really recommend speculating as a farmer. But it also can be a way, like I think we've talked to a few cattle feeders, right? That at some point you have to know whether the cattle feeding business is actually making money or not. And you have to have that moment in time where the grain side of your, say, farming operation hands that grain off to a separate enterprise and makes that enterprise stand on its own. So that's another best practice that we see the top 20% of our clients using.
So the second important aspect of what we're going to talk about today is separating futures and basis. So no matter what complex marketing alternatives you may have as part of your portfolio, ultimately it all boils down to what's my futures risk and what's my basis risk. They both have to be managed and measured and communicated, very importantly, in your strategy. And futures, again, are more of a best practice and a risk management function. Basis is a lot more learning and execution unto your specific markets and things that you can generally win in those details by having a bias or merchandising your grain around the current market structure. That is the right decision to make at that time, which, by the way, is completely, a lot of times, independent of what's going on in the futures market. And there's best practice to maximize both.
Yeah, so this is just, if you can take one of those little magic, we used to call them little nuggets from here. From now on, if you're in a crop that you're marketing that's hedgeable, right, you're going to separate those two conversations. And since the common denominator is futures, everybody has a transparent futures price. When you're out negotiating, right, you really want to just negotiate basis. So from now on, your conversations with your buyer post this are going to be, what is your basis, negotiate basis, and then talk about the futures as a secondary. Interestingly enough, the people that are in this business that have been in it for a long time, they hedge off their futures risk. So, I mean, those that haven't usually eventually have to leap or forced out of the market, right? It's very hard to speculate and win. The big grain companies, the ethanol, the crush plants, they're hedgers. And so they're hedging off the futures risk, and then they're working in this space. And I think it's a tell for us farmers to become that risk manager. You're managing off the futures risk. And then here, as Mike said, basis is much more geographically specific, and you can start to understand this. It's what makes grain move, particularly from one point to the other. Futures is a global contract, actually. Basis is what gets grain to either get moving or move from point A to point B. You can really start to kind of hone in on that as a farm. You can get some historical based numbers. You can kind of use prior years to get an incentive. And that's the way you can actually start to work on separating that decision when you're going to move on basis, which is really, if basis isn't appreciating enough, cost of storage, which we're going to get into, then grain starts to move. That's how the commercials do it. And then it's another little picture that we see, and we have it today, right, is we've had a nice futures rally, unfortunately, due to some global tensions, but you see basis dropping, right? Because futures is doing the work to move grain into the system, and we're getting too much grain relative to how much we need at this moment. So when you start to separate those two decisions, you can start to maximize, hey, I want to take futures off risk here. Hey, it still pays me to store grain. Let's go ahead. We can keep storing that grain and earn carry like an elevator. So starting to separate those decisions starts to give you some really neat insight and how to maximize both knobs in setting price, futures, and basis.
So best practice in basis is try to find your local basis history. Your buyers should have it. It's a very pragmatic ask that you can pass to them, and they should have it. I think the other good news is there are a lot of emerging data tools out there that are getting pretty close to prime time. I'll bet you by the end of this calendar year, you'll be able to find somebody out there that are on a more national or certainly regional level. We've even seen some databases where you can literally look around the rest of the United States outside of your world too, and get this basis information yourself in a world of AI and finding information out there. I think that's going to be in our hands pretty soon, and you might not have to ask your buyers, but nonetheless do that. That should be on your to-do list after this call. Really informs you, relative historic levels, relative movement and patterns that are important to your local market and help you maximize that extra value for your grain. Jeff sort of alluded to this already, but you should never ask your buyer in that initial conversation, what are you paying for soybeans today? Or what are you paying for corn today? In a flat price sense, you should say, what is your basis and only basis? That's how they think. That's how they're incentivized. That's how their P&L is determined. So you should, going back to this concept of leveling the playing field, talk their language. You will be treated differently. And once you really start to think the lens of this, you'll develop a much better feel about developing that bias, why basis moves the way it does. What are some things I should look to maximize in certain circumstances or avoid altogether when you know there's often weak moments of basis? Yeah, it's really start to think through your subsequent marketing decisions through the lens of basis.
All right, we're going to move on to number 3, near and dear to my heart and near and dear to Mike. So when you run a very large grain position, right, margins are very near, you absolutely have to be winning. You have to have details. There's no room when you're running a high volume, low margin, say export business for mistakes. And one of the key things you become the merchant trading, whether it's futures or basis, is you got to know your position. Mike loves to talk about you can't manage a risk that you don't know you even have. You make quicker decisions when you know what your position is. There are ways we see a lot of opportunity. We spend a lot of time, obviously, talking about how when you become a good merchant of the farm, obviously, there's a lot of benefits in the price, but some of the big benefits are spillover into how you run the operation, how you plan your space. You actually use less assets, need less space. We find when you become a really good merchant, you get up to speed on how a merchandiser thinks. It eliminates some surprises potentially in your operation. It gets everybody more on the same page. You'll understand how marketing alternatives work as they come into your position, what they're really doing to your risk. It clears, Mike has coined the thing, it clears headspace, right? People who trade futures a living guard their headspace, their thought processes. They know that if their thought processes aren't clear, they'll make relatively poor decisions. So having a really good position helps them make better decisions. On farms, we see a lot of farms have multiple stakeholders. Maybe one person is in charge of maybe merchandising and doing those kind of things, but there's usually other people that are involved in that farm and take up different roles so you can communicate better. And then finally, clear your mind to make good, clean executions. You know exactly what's going on. We hear a lot about farmers saying, I'm super emotional about this. When you know your position, you can operate from data.
I still have this simple plus and minus solar calculator from 1991 that I was given my first day as a merchant in Cargill. Still works, the gushy buttons. This is really all you need. So best practice as you get the numbers together in knowing your positions, and you start with your yields. They become, in essence, the long on that side of the ledger. A very frequent, and our customers that have been around us now for a while already have their position put together for this coming crop year. We've instilled into them that don't be conservative in this exercise, at least at this point. Naturally, farmers tend to be conservative in certain aspects of their business. And by the way, in some of those aspects, it's perfectly practical to do that, but do not do that when it comes to your yield estimates at this stage. You folks keep getting way better at this. And if you are sort of intentionally being conservative, you are already putting systemic risk into your position by not reflecting what it could be. APH is not a good number anymore, or, broad areas or county by county, or you should really be going down to the field level and getting those numbers together. And, your fields vary as well. No two parcels are exactly the same. Not only does it relate to your long and your position, but it's incredibly important to your space and related operations planning the closer we get to harvest. So having that number, and you don't have to take a lot of time, but just be practical and update it over the course of the year as practical or as necessary. Number 2 there, when we start to put these numbers in, we have a bucket for our futures risk and a bucket for our basis risk. Options contracts or related things are also a part of our risk tracker. And a very important part to options is they have to be delta adjusted. Delta basically functions as the percent probability of that option actually being in the money at time of expiry. So if you have a delta of 0.5, going back to the 50-50 discussion, so a put or a call today would have a delta of 0.5 at the money because we're 50-50 either way. So that means you have to, in essence, take whatever you have in that options contract and cut it in half because the market's saying that only a 50% chance of it happening. So delta adjustment is incredibly important in options. And as I already said, stay current, use data to inform your positions. We have a position tracker, and we'd be glad to share it with anybody who's interested. I credit Jeff on this. He brought his long history in trading and also sitting in the shoes of a farmer and built something that is incredibly detailed that we have not seen out there exist, and really, really informs how you then look at your subsequent risk management decisions after that.
Yeah. So if you're interested in getting a copy of that, we do like to set up a quick tutorial. Just send us an email. We'll get a little time that says helps give that. It's super easy to use. It's designed to be easy to use, not take a lot of time, but it applies a lot of theory, best practice through how this program works. And like I said, it is really the only one we've seen out there that actually is focused on your risk position. There's lots of programs out there that look at your volume and your contracts and stuff. That's not what this does. The fourth big bullet point that our best top 20% knows they really understand cost of carry now. Got to be a lot more important. Obviously, working capital costs have risen in the last 5 years. And so understanding exactly what it costs to carry grain on the farm is important. We used to and still do run into some people that say, hey, I'm not farming with the bank, so I don't have any cost of capital. And we say, no, there's, even if you aren't farming with the bank, you still would use an interest rate at least at risk free. Today, that's 3.64%, depending. Shrink on the farm is very real. In the elevator business in spades. So every farm is a little different. It's good best practice if you can kind of hone that down and find out, do some testing on what you put into your spraying system and what you take out and get a sense of what that shrink really is. There's a little bit of variable cost in this calculation. Think about insurance, think about aeration, things like that. And also in and out cost. There's a lot of older storage in here that is pretty costly when you really think about how long and what it takes to go in and out and how that might change your store, not store decision or how you go about it. So these are the things that a professional trader would look at as they're looking at, hey, should I fill this 750,000 bushel tank in Louisiana? They're going through these calculations and trying to see if it pays.
So we'll go through some practical examples, and these numbers aren't exactly current, but we like to use nice round numbers for easy figuring. So let's say you had a cash price at your bin for beans, in this example at $10. And it's important to price this at your bin because that's where it's most sort of raw value to you. And you had an operating line of credit is at 7.5%. You take that to get to a monthly cost. You take your $10 times this 7.5%. and divide it by 12. So in this example, the interest cost per month to carry grain is about 6.25 cents. Shrink is a biological and functional reality to all grain, and you should be calculating this as well. In this example, you can just keep it at a monthly rate because we use a 0.25% per month. That was a sort of a corporate operational number in our past lives. Sure, there are maybe times when it's a little higher or a little lower, but over time, it's a pretty darn good foundational number to use. And in this example, you take your $10 and 0.25%, and you get about 2.5 cents per month. So add them both together, it's about 8.75 cents per month to carry grain. And the good farms that we've been working with, and we also provide a very simple tool to utilize that as well, something we can also get to you if that's what you want. The well-managed farms know down to the fraction of a cent what their cost to carry is on a monthly basis because it greatly informs what you do in the go forward when you really think like a merchant.
Yeah, we definitely see farms that are very good at kind of switching over to the elevator mindset, actually extracting a fair amount more out of the market because they understand hedging, rolling hedges, their cost to get there, their cost of carry, and they're adding net value over their cost to carry to the farm. I know even in my own farm, we're bagging grain for the second year. That has been a substantial part of the profitability of our corn enterprise is earning carry in the marketplace. Locking in positive carry, right? You're sitting out there looking and, can we roll hedges? Can we sell a hedge that's further away that's, a more positive value? And then we have to develop a bias on what basis is going to be. A lot of times the day we do it, we don't know what basis is going to be 3 months away. We don't get that good look. Generally speaking, in most cases, this in North America these days, but because we're very, astute in basis and we understand some of the history and where we are, we can have generally a bias and we can earn money carrying grain. When we have really wide carries in the last 3 years where we've had some surplus, this has been available. There's been years when it doesn't pay, when markets are flat and inverted, and we'll move physical grain out of the way. We can still carry futures risk. There's just less expensive ways. If Mike's gave us our previous example, if it's going to cost you 8.5 cents plus just to carry the grain, we have other ways to carry futures if we even want to, but we're not going to hold out whole physical grain to carry that risk. And that's how the elevators do it. They're moving grain. If it doesn't pay to carry it, they're moving grain in good order. It's not perfect, right? On a farm, there's physical things that you can't move grain for various reasons, but it's all in your thought process that, since interest rates have risen and commodity values have risen, there's important money to be made, right? Being really on top of your cash and understanding how this, now this market structure informs me when we're going to carry or not carry the physical grain, and then really honing down. And the example, right? It's for every 200 bushels. If it's a penny a bushel, that would figure out how to just in managing money, it's $2 an acre. If you're 1,000 acres of corn, right, it becomes $2,000. Or if it's 10 cents you stack up, now it's $20,000. So being a really good merchant, there are no silver bullets here. I think people that say, just sign up with me and we'll sell you futures higher and things like that. It's a sign. We know that the way to improve your farm is to get educated and get in the details and then start to chip away at these things. We call it stacking dimes. And maybe it's stacking pennies. So we're overvaluing at dimes, but stacking dimes is the welding term. And then we apply it to the merchandising term. 1 penny at a time better, 1 penny at a time smarter on when to carry grain and when to move grain. Super important to a farm.
Certainly there are times, especially due to your local S&D or maybe where you naturally are in the Corn Belt, where you tend to get relatively inverted markets, especially the more the season goes, where the market is telling you, I need it now, and I'd rather not pay for it later. And when you get into situations like that, I'll talk about you really need to get off basis for sure, and maybe futures as well. But so some examples of how one executes when the market structure is in a carry or an inverse. The value of space is often in those first 90 days after peak harvest. And that often correlates with some of the widest carries. If you're fortunate to store all the grain you grow yourself, it's often that part's taken care of, and you can really look at just the market structure and merchandise around that and pick those widest points of carry relative to your cost to get there and start to make your marketing decisions at those most attractive points. The reality, though, not everybody has space for all their grain. And if the storage fees that you're being charged at certain points of the year, and around harvest is the best example, and their storage fees are less than either what you see in the market is to carry or what maybe your bias is telling you the ultimate carry will be, that's a great decision. You're basically paying less than the actual market is valuing, and you will pocket that difference. And the nice thing about storing externally is shrink becomes their problem now, not yours. So that's the sort of things that can go through your head when you're thinking about a carry. When we get flat and especially like explicitly inverted, and there's a lot of folks on this call that are in places where basis has not been particularly attractive, but we even talked with some folks shortly before harvest last year in Southwest Minnesota and Eastern South Dakota, where there was a small inverse that sort of poked its head up about 3 or 4 weeks before harvest. Well, if you're carrying any more grain and the market is here for right now and it's down here for harvest basis, you are absolutely moving that grain for sure off basis tomorrow, because you're both doing what you should be doing in an inverted sense as a merchant, but you're also freeing your space for your subsequent harvest needs and avoiding the reality often of the worst basis of the year when harvest actually comes. So 2 examples of market structures and how it somewhat automatically informs what you do. And that's what I like about what Jeff and I do. And we talked about ways to slow your brain down and create better definition in your marketing game plans. But the beautiful thing about becoming an educated grain merchant is a lot of times the decision is automatic. And certainly commercials will almost never hold significant inventories when the market gets inverted. So why should the producer?
Yeah, I think the only time that commercials really get out to carry it through inverses is when they have to, and they try to pass that risk. So that's things like crush plants and consumer type businesses where you have to have a pipeline. Feed mills always have a grain in the system, right? There's no not holding it. But yeah, commercials that are running strictly an elevator business, as soon as that market flattens out, they've got to get rid of it, because the interest cost will be more than the margin in a lot of, say, barge loading or train loading facilities. So back to this is just a basis carry, where you've got this 6.25 cents. You've got a little bit of basis carry from, say, a 25 under to a 15 under. So you had 10 cents in basis carry, 18 cents in board carry, which was pretty common here the last couple of years. So you have a 28-cent gross carry. Your cost of storage in this example was 18.7. So, there is money to be made, right? 9.25 cents net over cost here. which is material, right? Because we're talking about, now this is in beans, right? But that's another 10 cents, another $5 an acre on a 50 bushel bean. I mean, it's how we're squeezing out more money for the farm by being educated, but not by adding more assets or more investment, right? This is just a piece of the marketplace that Mike and I realized that the farmers just never had the detail, even through the land grant ag universities of classes that taught at this detail. And that's why we started the business. We knew there's a lot of money that can be made at the farm just through education.
So how do we connect with producers? Please feel free to reach out, email us, and we'd be happy to follow up. We're pretty active on X and Facebook. Great ways, obviously, through this platform today, but we have some legacy podcasts that are, especially the farm for profit ones. We've done 3 of them. Pick any one of them. The last one maybe is the best one. 3 is a charm, but we've done some stuff through Bloomberg. We did one yesterday that'll drop here in a week or so. StoneX and RJO, we did a series of 4 events. Top producer in Rush Hour Ag, and there's our contacts.
Thanks for joining us today. With that, I'm going to turn this back over to Megan.
Awesome. I do want to go all the way back to the beginning where you made a comment that I think is so important when it comes to hedging, that hedge accounts are not about making money from a farmer perspective. If it is, then you're Texas hedging, right? Like you're going for it. When you're doing proper hedging from a farm producer standpoint, it's about evening out the highest highs and the lowest lows and managing your risk. So I think that is such a key point, and just that idea of taking the emotion out of what can be a really tough, challenging decision on a farm. Thank you to our guest speakers today. I hope everyone has a great rest of their day. Thank you for listening to Compier's Ag Edge. You can follow us on Apple Podcasts, Spotify, or your favorite podcast app. For more agricultural finance insights and resources, visit compeer.com. That's COMPEER.com. Until next time.